No one likes paying taxes, but how do you feel about paying taxes on money that you never made? Crazy, right? Actually, it could be disastrous if you're having to pay taxes and the money didn't even come in. And like, where's that money coming from then to pay the taxes? Are going to have to come from somewhere else. But that could happen. It's called phantom income, and it's very common with an LLC because the income passes through to the members like a partnership does. And because of that, if the company doesn't make a distribution and instead it reinvests the money, then the partners could get hit with a tax bill. So let me explain how that might happen. So you've got this growing business, wildly successful, makes $5 million this year, and the members decide to invest all the money back into the business. Great. That's an awesome use of money. The company made $1 million profit. So what does this mean? You've got two members. Well, that means each would get a K1 for $500,000. The IRS would treat each of those members as if they made $500,000 that year, and they would have to pay taxes on that money. And again, where's the money going to come from? So what you would do is you would have the company make a distribution out to the members sufficient to pay the tax burden. That's called a tax advance provision, very common in operating agreements. And I think everyone should be worried about this, but if you're worried about this situation arising, then you want to make sure that you have provisions in there requiring the company to make a tax advance to each member sufficient to cover their tax burden. And I've seen the lack of this provision be used in nefarious ways. Let me put it that way. I'm going to talk about a real example where someone came to me. They were like the working interest of this company. They got an investor, and the investor put in money to start this company. And this company blew up in the first year and made a lot of money. But the company didn't distribute it out. The company didn't have to distribute it out because this investor designed the operating agreement such that he didn't need to. He could keep the money in the company and not pay it out. Now, why would he do that? Because he didn't like this working interest minority partner. They had a falling out, a disagreement, and so he used this provision to keep money in the company, but pass a tax burden onto this minority partner in the company. And it had the effect of forcing the partner out. The partner had to just give up his membership interest in the LLC because he couldn't afford to pay taxes. And all of this was completely legitimate under the operating agreement. The way the operating agreement was designed, this investor didn't have to distribute anything. And there you go. This is how the devil's in the details. Little things like this can really prejudice one party or another. But now at least you know about phantom income and that this thing can exist and that there are ways to avoid these things. If you need help with, any of your corporate documents, operating agreements, any of that stuff, we have tons of business attorneys at the firm. I'm a business attorney myself, and we would love to help you with your business. Thanks.